Welcome to the daily update, where I'll go over the action in the market for Tuesday, December 10th, and we'll see how things look for Wednesday, December 11th. Well, we see a bit more of a pullback developing and some of this weakness that was coming about last week, and we saw just kind of growing, even as we were setting all-time highs with the S&P. It's finally come through, both in Monday and now in Tuesday's session in price action actually going down. It still looks like we're in a pullback. So we're still looking okay as far as a trend in the short, intermediate, and long term, but there's some damage being done and there's some things to be concerned about. Now, the big thing on Wednesday is going to be CPI coming out, and that's probably the second most important economic report of the month after the employment situation report. So, can the market bounce up from this? Is it going to get spooked by what it sees? Is it going to confirm this scenario that the Fed is likely to cut rates? Now, we're also going to get PPI on Thursday, but CPI is the real focus. So, it'll be interesting to see just how this works out because we are seeing some under the surface concerns right now, but we're still positive on a trending basis. Please be aware of the SPX Investing Program. For a few more weeks, it's still free. You can check that out. There's a link that will take you to the website or to a video. You can send me an email and you do get immediate access to these videos. Also, the daily video, that's where I do my analysis and commentary about things. Over the weekends, I do all of the videos on the outside, except for the supplemental ones. I just do those on an as needed basis. But all of this is meant to tie into the daily video. Okay, let's go back and talk about what happened. We had kind of a flat open. There wasn't a real conviction, which I posted a video on the website. I usually do that right before the market opens. And I said, okay, you could take that as positive, and then we're not seeing a real gap down at the open. So a lot of people aren't freaking out from that aspect. But you could take it as negative since we had a down day on Monday and we're not seeing much of a bounce. Well, we just kind of continued. We are seeing a general pattern here where after the open gets dealt with, and that's usually the first hour and a half, 2 hours, sometimes even longer, then the smart money comes in and they start driving prices the way they want them to go. And we've seen that in Monday and Tuesday session. Later in the day, we see late day selling coming in. That drove things down on Monday, also happened on Tuesday. But right at the open, anyway, we had a flat open and we were able to go up a little bit. We hit resistance at the daily pivot at 6,063. Then we fell back down to the unchanged level. Then we chopped above and below the unchanged level for quite a while. There was really no conviction going on until we finally broke lower. We dropped down below S1 at 60.38. We found support at 60.30, a round number, and then we closed slightly above 60.30. We were down 0.3% on above average volume. So that's a couple of days now that we've been going down and we've seen volume actually picking up. We are still positive in the short, intermediate, and long term, but there are some concerns, especially dealing with the short term, where we're seeing some weakness. The weakness that we're seeing is actually in the intermediate term, but it's bleeding now over into the short term. And pretty much throughout the rest of the week, we also have negative seasonality. Of course, all the geopolitical things going on that really are not impacting the market. That's kind of interesting. You've got these major things happening, but the market's just kind of dealing with its own version of reality right now. So we did see late day selling that took prices lower again. It's kind of a continuation of what we saw on Monday. The mega caps did underperform. They were really what was driving the indexes higher last week. We're not really seeing that, at least so far this week. But support is holding for the mid caps and small caps. Now, we've been drifting back down. In fact, the mid caps are turning more negative in the short term. But under the surface, the growth to value ratios are holding up for the time being. And we came right down to a pivot point, and we closed right on the pivot point for the mid caps. We held above the pivot point for the small caps. So that should be taken as positive. We're not breaking through that, at least yet. We still have a non-confirmed Hindenburg omen. The parabolic SAR. This is kind of a big deal now. This is an intermediate term indicator. I also consider it to be a primary indicator, one that I really pay attention to. And that has now switched over to negative. We have a dot on top, and I'll show you that chart. We're just looking extreme with the stochastics. They move a little bit slower in the short, intermediate, and long term. That's the further subdivision of the short-term time frame. And they're rolling over. They're turning more negative, but they're still giving us some extreme readings. We still have the Sean trend meter looking a little bit extreme. And for right now, anyway, the NASDAQ 100's bullish percent index, it's holding up. It's looking extreme. It hasn't really started to fall that much anyway, so that's hanging in there for right now. No real changes to the current scenario. It'll probably get locked in more after we get CPI in Wednesday's session, whether the Fed will actually come in and cut rates next week. The dollar was up. Interest rates were also up. We're at 4.22% with the 10-year yield, where we had been at 4.2% after Monday. These still have these yield curves that remain inverted, and they have been now for a few years. The 10 to the 3, where the 10 to the 2 is still uninverted or going back to normal. I've been watching this 10 to the 3 month. Just it gets a little close, and then it starts to go back down with the overall yield curve. And because we haven't really switched, I go over that chart in the weekly video. Sentiment is still neutral. We ticked down a couple of notches to 48, where we had been at 50, and we're still positive with our trend. Now, we see another day or two of weakness, and that ADX could really start to turn down and possibly cross below the moving average. But for right now, it's still above the moving average, which suggests a strengthening trend, and we're still above 20, so we are in a trending environment. We're down on the day, so our bias is negative, and I've switched our momentum over to mixed. We'll have to see how this plays out as we go throughout the week. But we had been positive. Now, with a couple of down days and the weakness that was developing under the surface, I switched it into the mixed category here. We got the NFIB Small Business Optimism. That came out at 101.7. Last time it was at 93.7. The third quarter productivity, the revised version, and usually when it's revised, if it's not all that much different, there's not much of an impact, came in at 2.2%, which is what they expected and what we saw last time. Where we saw revisions was in the unit labor costs, and that was actually revised down. It was up 0.8%. They expected it to be up 1.9%, and that was what we saw in the first reading. So here is the chart of the NFIB Business Optimism Index here, and we are seeing an improvement. So this is rather positive for the overall economy here. Non-farm productivity and unit labor costs. We have productivity, the blue line, that's coming down, but it's still right at about the 2%. And unit labor costs on a year-over-year basis are also coming down. So that's seen as more friendly. Then we have, usually once a week or so, I show this chart. This is the overbought, oversold composite. We'd been getting some high readings above the 90 level, and that's where we tend to use this as a contrarian indicator. It's dropping down a little bit as the market has been under some pressure. Then looking at the valuations, we still have the US really high over that 20 level. With the PE ratio, we go from 10, 15 to 20. 10 and below is inexpensive, and then the sweet spot is considered to be 11 to 19. But then when we break above 20, that's when we're getting expensive. And we're above that at 23. And then you can see that compared to the other markets in the world, with emerging markets being the least valued right now on a valuation basis. Gold holdings versus gold price. We're seeing gold really going up, and this just breaks down. These are the blue area. These are central banks who've been buying a lot of gold lately. You have the price here in the kind of grayish blue, and then investors are down here along the bottom, and then speculators, the folks that maybe play the futures market, they add liquidity to the market and they make the bid-ask spreads really more advantageous. But overall, they don't do a lot of holding longer term. And systematic strategies, this is when folks just use the system. They don't really care what's going on technically. They just have a way of investing in the market, and they just do it no matter what's really going on, technically speaking. And we're seeing that that has been performing quite well. And when we're setting all-time highs with the S&P, like we were last week, this is when a systematic approach tends to work well. It's when we come under pressure. That's when this type of an approach, you can see back in 2022, this whole type of system didn't work all that well. And then record inflow into ETFs in the US, we're just seeing a lot of money. These really have become so popular. I base everything I do around ETFs, specifically the SPY, but then there are other versions of SPY ETFs that are either enhanced or inverse. But we're just seeing an awful lot of money going into that. And they kind of over the years have replaced mutual funds, even though mutual funds still have their place and folks have used them for a long time. ETFs have really increased in popularity. And then this is a chart I ran across put out by Bloomberg here. It says perhaps employment is not as bad as the revised data suggests. And that's what we've been concerned about is that, okay, we come out with this number, the market reacts to that, that gets baked into the market. And then the next month, the next report comes out, and then they're revising the previous numbers. And it's like, okay, can we trust this data? Is this something that we can really base decisions around? And somebody found this is looking a little more rosy, where we're actually going up with the leading index, and we could possibly be starting to go up here with the monthly change in the payrolls here. But again, you could take this and also make it look more negative as well. It's just somebody's interpretation of this chart. Okay, let's talk about what happened. Just pretty much a flat open, but we were positive when we got all the way up here to the daily pivot. That set the high for the day, and that's as high as we could really go. Then we came back down to the unchanged level, chopped above and below that for a while. And then we finally broke lower as the smart money came in and did some selling. We broke down through S1, came right down to 60.30, and then closed a little bit up off of that. And not seeing much of a change in the initial overnight session here. That's what you see way over on the right-hand side, the pink area, where we were seeing an improvement here with the futures, but that pretty much led to a flat open, and then we saw the decline happening throughout the day. This is still positive, though, when we see the blue line above the red line. Large cap growth is still outperforming large cap value on an intraday chart. And we're still holding up okay here with our growth to value ratio for the S&P. It's bottomed in November 27th or so, and then we've been seeing this really coming back up. And this is what's helped the indexes to go back higher. We're not really doing much over the last couple of days, but we're not breaking down either. So on our end of day, we were down with growth, but less than value, down less with the mid caps and down less with the small caps, even though everything turned out to be negative. So the growth to value ratio for the small caps still holding up, not quite here at a golden cross yet for this ratio to start showing an uptrend. And also seeing a recent golden cross here over the last day or two with the mid caps, where even though it fell down, as long as this ratio stays above both of these lines, that will turn the lines more positive. And still holding up okay here with the S&P growth to value ratio. It did decline and has over the last couple of days, but we're still in a longer term uptrend. Still hanging in there pretty good when we look at the growth versus value ETF. And the discretionary to staples ratio coming down a bit here, but still looking pretty solid in the longer term. That's why this is part of the reason why I say, okay, it looks like we're just pulling back to this point. We're not really seeing a deterioration of these growth to value, discretionary to staples ratios. Large cap growth pulling back after setting a recent all-time high. And the condition of our trend, this is what I'm talking about with the ADX, starting to roll over here. And another day or so, and we don't see a real positive move with the green line going back up, we could actually cross below the moving average. So we're seeing the green line coming down as the red line's been coming up. Short term also getting really close to that moving average, but we haven't quite crossed yet. And we are picking up a little with volume, which is kind of a concern when we see things going down and volume increasing. And I usually don't show this chart because there's so many crazy diamonds on here that it's like, okay, what can you take away from this? But looking at this particular chart, if you notice way over on the right-hand side, these are sentiment gauges that we look at. And a lot of them, and here's the list of what we talk about or what's listed here. And I do talk about some of these, but a lot of folks are just getting a little too complacent about things. They're just assuming things are going to go up. And we're seeing that really lean more towards the risk on. They're willing to get more into stocks instead of the safety of bonds or money markets or things like that. And we did go up just a little bit here with the VIX, both with the line chart and the bar chart. And the VIX of the VIX is also showing a bit of an increase, but we're still below the moving averages. Now, the VIX had really fallen. And so to see it bouncing back up is not really a surprise, especially as we're going down right now. But the momentum of the VIX is starting to cross back up and look like it's positive as measured by the MACD. So that could be a little negative until we see the VIX really start to drop again, which means stocks are going up. And this is outdated here. This was over the weekend here. It says volatility falls as the VIX moves below 13. Not anymore. It's now going back up. In fact, the latest reading here was at 14.81. And this is the seasonal chart. I've been showing this for quite a while now, just showing that we should, at least on a seasonal basis, continue to decline here with the VIX, which means stocks are going up. And we're coming down a little bit more with the SKU index since we saw a little bit more of a decline. So what's it going to take for this to actually come down up out of the red shaded area? The market's still expecting some kind of a big move. We'll see if CPI can give some clarity to this. And we ticked up with this one fear gauge, and we're also going back up with the other fear gauge. So we're seeing a little bit more confirmation as fears slowly coming back into the market. And then the put call ratio. Now, this is a little bit different than what I show right after this. This is the US put call ratio. I break it out into the equity put call ratio. I'm just looking at stocks, and we were getting kind of low readings, but now it's starting to go back up. And this is the daily chart here where we actually declined on a down day, and we're still declining with the 5-day moving average of the equity put call ratio. Here's a longer term look at that just to give you some perspective here. But we're ticking back up still with the 10-day moving average. So a bit of a controversy there, or conflict, I should say. And we're seeing an increase here with the volatility risk premium. It had been very low as the S&P was setting all-time highs. Now there's more perceived risk, according to this indicator, going out 30 days. And we're still holding up with the advanced decline lines, but we're seeing a lot of red here and not much green as we're coming down based on price and volume. Also, we're still seeing more new highs than new lows, but we're really falling back here with the new highs, a real contraction here. So both our 5-day and our 10-day moving average are now declining. And we're dropping below, further below the midpoint here with the short-term advanced decline ratio, that's blue, and still barely positive with the intermediate term advanced decline ratio. So I wanted to show this because this top part is just basing things on price, and we're dropping below zero there. And it's the 19-day advanced decline ratio. What's a little more concerning is we're dropping below zero now based on volume. And we're just about ready to come back down and cross below the moving average when we look at accumulation distribution. It's not getting quite picked up here with the boom indicator. Seeing how close we are to the moving average, the boom indicator should be closer to this zero level. But this is showing some negative action right now. And we're also going down with the Chaikin money flow, another smart money indicator. We're going down with the histogram and down with the red line. And we're actually crossing negative with the Chaikin oscillator. It continues to decline below the midpoint and pretty much flat with the vortex with the green line, where we're seeing an increase here with the red line, but it's still positive. And a little bit of a pullback here with the advanced decline line for the S&P based on price and volume. Also seeing a decline with the S&P going down and the NYSE going down as well, coming down to its 50-day moving average. We'll have to see. This doesn't seem to be a moving average that we will really often provide support. And then the cumulative advanced decline line for the NYSE actually dropping a bit below the moving average here and showing a decline, but still above the moving average with the regular NYSE advanced decline line. Seeing pretty much that same thing here. Decline, but still above the moving average with the other NYSE advanced decline line. And coming down with the advanced decline line on common stock, where we were a little encouraged. This actually blipped up a little bit on Monday. We're not seeing that happening after Tuesday's session, either on price or volume. And coming down to the moving average with the NYC common stock when looking at the advanced decline lines, a little bit above the moving average with the S&P, dropping below. The mid caps are actually showing a little bit more weakness where they had been seeing strength not so long ago, just last week, and still holding up a little bit better with the small caps. Now, is this going to be a self-fulfilling prophecy? Because usually this is the time of year we're coming into it as we get closer to the middle of December, where the small caps tend to perform well, and quite often the mid caps do also. Is that going to end up happening? Everyone's pretty much assuming that's going to happen. Sometimes the opposite is what ends up actually happening, but we'll just follow it and see how it plays out. We're still negative here with the stocks above their 20 period moving averages inside of the S&P. So short term, this is showing some weakness. We're also declining with those stocks above their 50-day moving average, 100-day moving average, and 200-day moving average. And then here is a little bit above the moving average as far as volume, and we can see the decline after setting the all-time high last Friday. We're still declining with the 20, 50, and 200-day moving averages on the S&P. Actually getting kind of close here with the Stochk RSI to getting an extreme negative reading, but it's just negative right now. No longer extreme positive with the Williams percent R, also going down, but still above the midpoint with the CCI 14 and the CCI 20. And no longer extreme with the short-term stochastic, but we are rolling over and still extreme with the intermediate term and crossing below the moving average with the long-term stochastic. And coming down, but still barely positive with the force index. And dropping below the line a little further here with the condition of the short-term trend based on 20 periods. The longer we stay below this, the more these lines may in fact roll over. But we're still above the simple and exponential moving averages. And we're kind of coming down into the high end of the +1 channel with our standard deviations chart. And coming down, but still positive with the balance of power. Dropping a little bit below the blue line here with the condition of our intermediate term trend based on 50 periods. And turning to the lighter shade of blue with the go, no-go system. Coming down, but still above the midpoint with the highest high value. And still looking a little more negative with the darker blue with the TTM squeeze. Still positive, but declining with the ease of movement. The Arun has not changed, but still positive. And coming down here with the S&P McClellan oscillator below zero and continues to decline. So we're going down with the summation index based on price and volume. Also below zero with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume here as well. And still looking negative, we're declining with the Swenlin trading oscillator based on price and volume. And momentum is starting to take a bit of a hit here. We're coming down, but still above the moving average with the PMO, where we've already crossed below the moving averages based on price and volume. And I pointed this out in yesterday's video. We saw a bit of a tick up with the PMOs that were rising. Well, that got worn off and taken away after Tuesday, where we're now declining with those PMOs that are rising. We're also declining with the buy signals. We're flat to slightly declining with the PMOs above zero. And slope oscillator, which had been improving, is still looking rather positive, but the MACD is starting to roll over and in danger of dropping below its moving average. So shorter term, the slope has kind of been going the opposite of what price has been doing here. The TSI has been a little more realistic. It was positive when we were going up, and now it's starting to roll over. And we're seeing some weakness here with our intermediate term oscillators and a little bit of a turn down with our longer term oscillators. Still positive, but not showing a lot of strength right now with the Copic curve. Coming down and still looking kind of extreme with the Sean trend meter. Coming down after being extreme with the money flow index as well as the ultimate oscillator, but both are still above 50. Coming down is still above the moving average here with on balance volume and declining, but still in the 50 or above 50, I should say, with the RSI 14 and RSI 9. Rolling over a little bit here with the Pring bottom fisher, which seemed to give us a really nice buy signal here, even though, as I've been pointing out, that's not really what this was designed to do. And we're still above the moving averages that are plotted here, even though we're seeing a little bit of recent weakness. And we're continuing to be neutral with the Elder's Impulse system for the S&P, but we have a dot on top now with the parabolic SAR, a primary indicator that is now turned over negative. And we're declining here with the bullish percent index. That's also negative, even though we're still technically positive since we're above 50. And we're declining with the NYSE bullish percent index, but the NASDAQ 100 bullish percent index is still holding up fairly well for right now. And we're keeping an eye on this longer term trend channel. And you notice where I put this. I put it at the very low that we hit back in 2009. And then I just drew a parallel line, mainly trying to get these highs that were set back in 2013 into 2014, even into 2015, and then just extending that forward. And we went above it in 2021. We're coming right up to that level now, which may be causing some longer term resistance. Now, the reason why I say note where I drew these, because I have another chart here. They actually do it a little bit different. They're going off of these highs too, also drawing a trend channel here. Now, in this context, it's looking a little more positive. We're just coming up to the midpoint, where the way I drew the chart here, we're actually at the upper end of the trend line. So again, you can look at the same data, draw lines just a little bit different, and come to a different conclusion. Now, even though this previous chart, we're still positive here. We're just wondering if this line is going to provide some kind of resistance, where here, maybe the midpoint is actually providing some kind of resistance. Okay, and we're looking a little more negative with the Heiken Ashi. We see the dark black candles here, pointing down, but still positive with the Kagi chart, still positive with the Renko chart, and we're turning a little more negative now with the three-line break chart. No long-term charts here. We're seeing a little bit of weakness in the 150-day moving average, but still it's been quite positive for most of 2024. And they actually did an update here with the Keller market model. We've turned negative in the short term with the mid caps. All the other indexes are still positive on all the time frames. No changes here. Still looking negative in the intermediate term with bonds based on price. Commodities are still under pressure on all time frames. And we saw where communication ended up being up. That's a growth area. And then discretionary was up just a little bit here. That helps. But staples were also up. And then the rest of the sectors ended up being down. Real estate, which was up in Monday's session, was down on Tuesday. And tech, we want that to be doing better than what it's doing right now. And I'm seeing a lot of Christmas colors here, where we had a BPI cross below 70 with the tech sector, where communication had a cross above 80. So that's still looking pretty good there. The NASDAQ got to 19.8, setting an all-time high and a four-year high. Canada setting another high. Then we saw some weakness later on in the day with the NASDAQ. And then the communication sector had the BPI cross above 70. So there are some positive things happening here that are more growth related. We're now just not really seeing it reflected in price. And we're coming down here with the weighted and equal weighted version of the S&P currently, and we're seeing this ratio going up as the weighted version of the S&P is holding up better now than the equal weighted version. The Dow's coming down here after last week, just setting a new all-time high. The second day now that we're negative with the Dow. And the NASDAQ dropping a little bit below this pivot point here. This may still be providing some kind of support, but it's getting a little dangerous there with this pivot point. We're actually dropping below the pivot point now with the NASDAQ 100, but we're still neutral with the QQQs, with the Elder's Impulse system. The momentum showing a little bit of weakness, but is still positive for the NASDAQ 100. And this is the small caps here, where we came down to this pivot point and we were able to bounce up off of that and close off of the low. For right now, that should be taken as positive. And we're coming right down about to the midpoint here with the Russell 2000 small caps, with the RSI dropping just a little bit below 50. And the momentum is negative here as well. And we're still negative with the small caps when looking at the Elder's Impulse system. And then we close just about on the pivot point here with the mid caps. So you could say that this support is still holding for the time being, but we're still negative with the Elder's Impulse system with the mid caps coming down after setting an all-time high with the Wilshire, also pulling back a little bit more with the total U.S. stock ETF. The FANG index is still hanging in there okay. It's down 0.25%. And we're still wondering if the shorter term trend line is providing overhead resistance with the FANG index. Apple ended up being up 0.41%. Amazon was down 0.46%. And Microsoft was down 0.6%. Google was up over 5.5% here. So that kind of held things together. Meta was up almost a percent. That also helped things hold up better there. Nvidia, though, was down over 2.5%, but almost 2.7% and starting to fall underneath its 50-day moving average. Tesla was up 2.87%, and this is what helped the discretionary sector to hold up pretty well. Netflix, virtually unchanged after setting a recent all-time high. And we're still seeing an improvement here with the short-term correlation and the long-term correlation between US stocks and world stocks. Oil is up 1/3% here after it had been falling. And we're keeping an eye on this. This is still causing us some concern. The semiconductors were down 2.38% as a sector, still below the moving averages, still seeing a recent death cross here. And that's causing some concern. And we're starting to go down again here with the semi to Dow ratio. We want this to go back up. That means semis are outperforming the Dow, and that's not what we've been seeing recently. And this is another new chart that I started including. When this is going down, this means the semiconductors are outperforming the tech sector, not like what we were seeing earlier in 2024. We want to see this turn and go back up. If it continues to go down, that is a concern. And then this was posted by Chris Schiavocco on X or Twitter. This is a 60-minute chart of the semiconductors, where this is right after the election here. Well, no, this was the end of November. Okay. Where we had a gap up here, and then we were really showing some improvement, and that was rather encouraging. But now we're starting to see some weakness, but we're still coming back down. Have we filled in this gap now? Are we going to be able to bounce up off of that? So, well, again, I've been watching this sector pretty heavily lately because it's very influential for how the market performs. And the dollar was down just a little bit in the overnight session, but it was up on the day. And we're going back up with the 10-year yield. We're going down with the 10-year based on price, putting some pressure on stocks. But the growth to value ratios holding up for right now with cues to S&P, discretionary to S&P, and large cap growth versus large cap value. So we're still looking okay here with the large caps, mid caps, and small caps, although they showed a bit of weakness for the mid caps and small caps. And we're still going up here when we look at the S&P to utilities ratio. That means the S&P is outperforming utilities. So what's our outlook for Wednesday? On Thursday, the European Central Bank will be meeting. Of course, that'll be all done and decided before the market opens in the US later in the week. But still, what happens in Europe, we want to pay attention to that. We're still positive and in the bigger picture, we have positive seasonality. We're just seeing short-term weak seasonality right now, and the weakness that started to develop last week is continuing to play out in price action. We're going to get the MBNA mortgage applications index. The big one is going to be CPI. And then all the crazy stuff going on in the world to see if that will impact the markets. Then we're going to get PPI on Thursday, and those are the two big ones. Wednesday and Thursday are the big days for reports. We will get import and export prices on Friday, but that's usually not that big of a deal. And this just shows Wednesday and Thursday. What I do with this particular calendar is if it has 3 stars or greater, that means it's really important. And I sort it based on that. Otherwise, we would get a list so long that it's almost unreadable and unusable. Here's the seasonality going back the last 21 years. We are neutral to positive with the Dow, S&P, and NASDAQ, but this is the weak seasonality that I've been showing. And so far, it actually kicked in a day early. It looked like we should have some positive seasonality going into Monday's session. Well, that really didn't play out. And now we do see a bit of a drift off here until we get into the early part of next week. But we are going to get CPI coming out. The market could react either positive or negatively to that. We'll just see. Okay, then Wednesday in 2023 was the most negative day of the week, and it's performing a little bit better in 2024. And then we're coming more into this time now where Tom Bowley's research is showing this is where we often see a pullback seasonally. And so far, it seems to be playing out that way. So the warning signs, our smart money indicators are now turning negative. Unfortunately, we're still going up with the 10-day equity put call ratio. The 5-day is going down, and we're still negative with the S&P and NYSE McClellan oscillators and summation indexes. We still have a non-confirmed Hindenburg omen. Parabolic SAR is now on this list on the negative side. The Swenlin trading oscillator is still negative, and we're still negative. We dropped below 50 with our 20-period moving average study of those stocks inside of the S&P. Then on the positive side, we're still going down with the 5-day equity put call ratio. The vortex is still positive. The growth to value and discretionary to staples ratios are holding up for right now. The oscillators are still positive, but they are starting to show some weakness. And the Copic curve is still positive, even though it's slowing down. The advanced decline lines are positive, but also showing weakness there. Showing weakness, but still positive with the 50, 100, and 200 period moving average studies. And we're still looking extreme and holding up for right now with the NASDAQ 100 bullish percent index, where we're declining with the S&P and NYSE, but we're still positive since we're above 50. Ease of movement, money flow, and ultimate oscillator showing declines right now, but still positive. And the momentum for the NASDAQ 100 showing some weakness, but still positive there. The financial sector is still seeing a little bit more weakness right now, but it's still positive in the bigger picture. Then we have the Hindenburg omen here. No confirmation spike yet. So we still haven't until December 19th for that to finish itself. All right, our conclusion. We are positive, but yes, we're pulling back. And that's what it looks like right now. We're not just switching over full-blown negative, at least yet, but that's why we watch this on a day-by-day basis. We do have positive seasonality in the bigger picture, but we are seeing this weakness that's been developing. And we have weak seasonality in the short term as we are pulling back, as well as in the intermediate term. This is where a lot of the indicators that we follow, they were starting to flash some warning signs last week, but we are still positive in the long term. Thank you. I hope you have a really good day, and I will talk to you in the next video.